Marco Simon, welcome to the Rational Reminder podcast.
Thank you so much for having me on here. I'm really excited to talk about passive ownership.
Awesome. We are very excited too. So to start on that topic, how much of the US stock market is owned by index funds?
So if you want to pay attention to the words, you said by index funds. And so if
Yeah.
we want to think about strictly funds that are, and remember, index funds is actually quite a broad thing. So, there is stuff that we think of like passive ownership, like VTI, which holds the whole market. But then there is stuff like COWZ, which hold, the 100 most profitable stocks in the Russell 1000. And that was so successful, they launched CAF, which owns the 100 most profitable stocks in the Russell 2000, right? And if you add up all things that track an index, that's about 16% of the market.
Hmm.
And how does this differ from, say, 20 years ago?
So, SPY, I think, was launched in 1993, right?
Yep.
And so that was the first ETF. And before that, Vanguard had some smaller, pretty small index funds that track the Vanguard 500. And so I think about 20 years ago, index funds owned about 2% of the market, and it's grown a lot since then.
Now, you kind of alluded to this. Is index fund ownership a complete measure of the total assets that are managed passively?
Not necessarily. And I think that, Alex Chinko and I have this paper, the passive ownership share is double what you think it is. We make the argument that there's a lot of other passive vehicles. So for example, if you look at Utah Pension Fund's 13F filing, so these are every institution that has more than 100 million has to list every security they hold, every equity they hold. And you'll notice they hold 1,000 stocks. And these are the Russell 1000. And right when the Russell 1000 drops some stocks, Utah Pension drops it too. When Russell 1000 adds them, the Utah Pension adds them. And so you can imagine this is a form of direct indexing, right? They on their own, rather than pay a management fee to, BlackRock to hold IWB, they do the Russell 1000 on their own. I, also use a robo-advisor, right? My robo-advisor replicates an index for me, right? And so that's another form of indexing. And so if you try to add up all these, and there's also shadow indexing, which we could talk about more, I think later, right? There are people who say they're doing something active, but they might have some portion of their money which is invested passively. And so when you're going to count up all that stuff, the number is going to be much, much higher.
So can you talk about just the challenges with measuring how much assets are held by passive investors?
Right. So, for example, Utah Pension Fund's 13F doesn't come, and I don't mean to call them out here, right? This was just, one salient example when Alex and I were working on the project.
It's a well-known example, though. I know it's the Nevada one that's a well-known example too, right?
Right. Yeah. But I think Nevada, they have that really famous New York Times article, but I think they're literally buying the ETFs. And so Nevada will be easier because then we will just count up, how much money is in the ETFs they hold. I think the challenge is there's a few different challenges. One, when you look at a 13F for, say, Utah Pension, there's no tag that says, oh, we're holding the Russell 1000. So you're going to have to figure that out yourself.
Yep.
The second thing is if you look at, say, a 13F for a financial advisor, right? Maybe for you, you're doing some individual replication of the Russell 1000. Maybe for me, they're doing an individual replication of the S&P 500. Maybe for Cameron, it's the NASDAQ 100, right? And if you try to kind of look at across all of us added up inside one institution, it's going to be hard to figure out, especially given overlap in indices, who's doing what, right? And the third thing is, and this is something actually, that I could talk about later, is that it turns out using holdings data, there's a lot of issues. John Shim and I have actually spent a lot of time, and we could talk later about this, and we've talked about some other projects I'm working on. The holdings data is actually kind of tricky to work with. It's disclosed at low frequency. There's delays in reporting. And so trying to figure out who's tracking what from holdings data is actually kind of hard in and of itself. It's a separate problem. And so there's a lot of challenges to measuring how big passive ownership is.
Can you talk about the approach you take in estimating the total passive share in your paper on this topic?
Right. So, Alex and I said, well, if the holdings data is going to be hard to use, what other data can we have that we have a little more certainty of? And so we said, well, what if we went through the idea and thought, if you were tracking an index, how would you trade? So if you were tracking the S&P 500 and a stock gets added to the 500 or a stock gets dropped from the 500, how would you trade? And the logic was, well, the dollars traded in that stock would be equal to how much AUM you have tracking that index times the index weight. So this is one equation, one unknown, right? We observe the dollar volume. We know from, you can get data from Russell or S&P or whoever on what the index weight is, and we can literally just divide them and get an estimate of the AUM index. Now, if you want to be even narrower, Alex and I went down to the TAC data and we said, look, if you really wanted to minimize tracking error, you would trade in the closing auction, just like all the index funds do, right? To make sure you hold the stock at the price that it's added to the index. And so you could, again, even further just say, well, dollars traded in the closing auction, in the stocks that are added and dropped, on the day it's added and dropped, right? Divide that by the index weight to get an estimate of AUM indexed.
Can you talk about the definition in this paper? How are you defining what a passive investor is?
Right. And so there's going to be a few different things that are going to kind of get lumped together, and we can loop back to what we talked about earlier, right? So if you think about the index funds that we talked about, so if you're an S&P 500 index fund, you are going to be classified as passive under our definition because you're very, very likely to trade in the closing auction in the stocks that get added and dropped. Like the tracking error on the really, really big passive funds is essentially zero. We're also going to classify someone like, who has, maybe Utah Pension, if they have someone trading on their behalf. If they're trading in the closing auction, we're going to classify them as passive. Now, to clarify here, you might say, well, why doesn't Utah Pension, if they know, remember, Russell discloses a month in advance, essentially, and the weights are, and who's going to go in and out is fixed even earlier than that. Why don't they trade earlier or later? That's a great question. If you look in the data, Alex and I kind of have the picture that motivated this whole thing, which shows there's like no run up in trading before, everyone trades in the day of, and no kind of slow unwinding afterward. And this is what you might actually predict in some like old models of trading. Like you want to trade where the liquidity is, right? So if all the big index funds are trading there and everyone knows the big index funds are trading there, why not all trade at the same time? But, that's another people. Anyone who trades in the close, like, if Utah Pension trades in the close. Now, suppose you're an active manager. Suppose you have 100 billion AUM. You have 50 billion of good ideas and 50 billion you don't know what to do with. Well, maybe then to minimize tracking error against your benchmark, you're also going to, when like they add Tesla, and Tesla's going to be an index weight of 1.8% or whatever it was when it got added. Again, when Tesla gets added as an active manager, among that 50 million in your portfolio that you are using to track your benchmark, we will classify among that 50 million that you are passive. So I guess it's those three things, like people who have a portion of their portfolio allocated, people who are replicating the index directly, and then actual passive funds.
You mentioned the closing auction a couple of times. Can you just explain for listeners what that means?
What it means or why we're focused on it, I guess.
Well, just what it is. I don't know if it's a common term that everyone's going to be familiar with.
Oh, okay. So at the end of the day, kind of like any other auction, right? Once you get close to the end of the day, you can submit different types of orders to trade in an auction. And so two important ones to think about would be a market on close order, which says in this closing auction that's going to happen at the day, regardless of what the price is going to be, I want to buy a certain number of shares or sell a certain number of shares. You could also have a limit on close order, which says in this auction, and this is going to be important for determining the price, right? I am willing to buy this many shares at this price at the end of the day. And so an index tracker would be willing to put in the market on close order, say for a stock added to buy it. Why? Because the closing auction price, which is the price that comes out of this auction, is going to determine the price at which that stock is added to the index, right? So if they put in the market on close order, they're going to have no tracking error with respect to that ad because they're going to get the stock at the closing auction price.
Got it.
So which indexes do you look at for your estimates?
So we focus on a subset of indices that we have data on. And of course, there are a whole bunch of indices. Like we said, we're not the Cows 100. We don't have in our data set. We have the Russell 1000 and 2000. And the reason is, and we can come back to this later, it turns out, dividing a big number by a small number can create problems. And so we have to get the weights really, really, really right. If you think about a stock being added to the Russell 2000 or added to the Russell 1000, right? That calculation has to be dollar volume divided by the weight. And so that weight is a really small number. And to make sure our estimates are precise, we have to divide by the right weight. And so we look at the Russell 1000 and 2000 because we have daily weights directly from Russell, on what the weight of every stock is at every point in time with a high degree of precision. Similarly, we have pretty good data on the S&P 500 and S&P 400 for index weights, and we have the float adjustments too are important, right? If we go back to Tesla, right, I think when they were added, it was like around 80% of the cap was considered float. So if you had guessed their index weight without the float adjustment data, you would have massively overstated what their index weight would have been. So again, we have really good data on float adjustments directly from S&P on the S&P 500 and 400. So that's, again, the mid cap and the large cap. Finally, we have the NASDAQ 100. Which has, QQQ is a really, really big ETF. We wanted to make sure we picked that up. And so we just focus on those indices because we had really good data on the index weights and the float adjustment factors to figure out what the, right number to divide by is.
Okay, so the headline finding, based on that approach, what is the total passive ownership share of U.S. stocks?
So that number, with just those indices, we have that 33.5% of ordinary common shares traded on major exchanges. So to be clear, this is like, not focusing on like SPACs and MLPs, like focusing on like ordinary common shares like Apple and Google traded on NASDAQ or traded on NYSE. We have that it's about 33.5% with just those indices we looked at.
Wow. And how much bigger does that number get if you include other indices?
So, if you think about like Vanguard, right, they started switching in 2014 and completed the switch to using CRSP, Center for Research and Security Prices indices, right? And Vanguard, has the largest mutual fund in the world, VTI. They have like a huge number of other very popular cap-based, growth and value-based index funds. If you just add Vanguard to our number, you're getting a number of 38.5%. And that's not even including the cows and the calves of the world that would easily get you over 40%.
Wow.
Yeah, super interesting. So you gave the bucket of active managers who might be allocating passively will be included in this number. How do you know like a lot of that number isn't that?
Right. And so this is one of the reasons it's important to get the weights so accurate. Because one way that Alex and I are going to check our estimates is that at any given point in time, especially with something like the Russell, where there's a huge reconstitution, there could be 10, 20 stocks that are going to get added to the 2000. There could be 10, 20 stocks that are going to get dropped, right? And so at any given point in time, for each stock that is added and dropped, we will have an estimate of the AUM tracking that index. And so then what we could say is, look, suppose all those numbers are really similar, right? The AUM tracking the S&P 500, say, is 5 trillion. Everything we have is right around 5 trillion. So I'm just making the number up. Then you would have to argue that the active managers were all buying in proportion to the float-adjusted market capitalization of each add and drop, or selling in proportion. And like, if you have 20 stocks being added and you're going to tell me that all the in perfect proportion, well, if they're doing that, I'm going to call them indexing. Like, you can call it whatever you want, but if you're buying everything in proportion to float-adjusted market capitalization, you are indexing. I'm sorry.
That's pretty funny. How consistent is the estimate? So like, for example, if you look at different stocks on the same trading day, are they going to imply a similar estimate of total passive ownership share?
Right. So just going back to that estimate, we have a table, I think it's table 5 in the final version of the paper. And let's just pick one index. Let's pick the S&P 500. So we have that S&P 500 trackers own, at the end of the sample in 2021, 17% of the ordinary common shares traded on major exchanges. Our estimated standard errors on that is 80 basis points. So our within event variation around that 17% is like plus or minus 80 basis points on average. Wow. And so I would say, again, remember, we're dividing a huge number, like multiple trillions, by a small number, and we're getting that kind of precision. It suggests that the trading among stuff added and dropped on the same day is pretty tightly clustered.
Yeah, that's really cool. What do your findings suggest about the validity of the Grossman-Stiglitz framework for how investors choose between active and passive investing?
So first of all, let's zoom out and say, what is the Grossman and Stiglitz framework? So the Grossman and Stiglitz is a super famous paper from 1980, I think, which made this point about why markets can never be perfectly informationally efficient, right? The idea is, if everyone is learning, there's always going to be some person who's like, well, prices are going to be really efficient, and learning takes effort. I love to tell this story. So when I was in college, I was the head of the investment club, and we had managed this little portfolio for the endowment. And one of the guys who was in the club with me worked for an unnamed, active investment manager. And his job was to drive around rural Massachusetts and count up RVs in RV dealerships. Because the manager believed that RV sales, like in real time, you didn't have to wait for earnings. He could predict RV sales by looking at how many RVs were in RV dealerships. However, like, this was costly. They had to pay him, they had to pay other people to collect this information, right? And so if information gathering is costly, once 100 people are driving around Massachusetts and gathering the RV, you don't want to also do that. And so there's 3 types of investors in Grossman-Stiglitz. There's the informed investors who drove around Massachusetts and got the signal. There's uninformed investors who are still sensitive to prices, right? They don't want to buy when prices are high. They want to buy when prices are low. Very simple. And then there's noise traders, basically people who you could imagine, suppose you work at an RV dealership, you get some employee comp in RV stock. That's correlated with your labor income, and so you sell sometimes when you get some RV stock. And so in Grossman-Stiglitz, basically, I think what your question is trying to get at is like the decision to be informed or uninformed depends on what you think everyone else is going to do, right? If you think everyone else is going to be informed, you maybe decide, okay, I'm going to free ride. If you think no one else is going to be informed, you're like, well, now's the time to learn a lot and really profit from my informational advantage. And I think what Alex and I are trying to get at a little bit in our paper, kind of speaking to this as like a super classical framework, is that, well, if measuring passive ownership is hard, the idea of Grossman-Stiglitz is what's called an REE, or, a perfectly rational expectations equilibrium. Everyone knows everything. But if not everyone knows what the true passive ownership share is, how can everyone decide perfectly in equilibrium how much they have to learn relative to how much everyone else is learning? That's kind of how we think it speaks to that.
It's really interesting. I'm curious, if passive owns so much of the market, why don't stock prices move more on the reconstitution days?
Well, I guess then here I get, maybe I'm telling too many stories here, but this is one I like to think about, right? So, on Thanksgiving, are turkeys expensive or cheap?
Expensive.
Really? Many stores, as far as I've seen, maybe I'm not a huge, I haven't gone to a plethora of stores, but in fact, many turkeys are usually offered as a discount, and they're usually relatively cheaper on Thanksgiving. Now, why is that? Because the whole year, stores know Thanksgiving is coming, and they can freeze turkeys because turkeys can be frozen and preserved frozen for a significant amount of time. They can freeze the turkeys, bring out all the frozen turkeys on Thanksgiving, and they're not that expensive. Now, if I was to say Valentine's Day are roses expensive or cheap, you'd say roses are expensive. Why? Well, we can't freeze roses a whole year. That doesn't work.
Huh.
And so this kind of leads to some other work that I've done with Robin, and maybe we're going to talk about that later. But there's two possibilities. One is, people are just really good now at freezing the turkeys and bringing them out when they're added to or dropped from indices. Another possibility is that the price effect has just moved somewhere else in time. So like maybe back in the 80s, like when stock got added to the 500, prices went up on that day. Now there's, a desk at, every investment bank and every hedge fund trying to predict index additions a year in advance. They're very slowly building up that stock of turkeys and pushing the price up the whole time. And so by the time it actually gets added to the index, we don't see anything, but that's because we're looking in the wrong place.
How have the price...
Go ahead, Ben. Sorry.
Do you have a question?
I was just saying, I might use that turkey example going forward. That's a good story.
I did not know that the prices of turkeys were cheap on Thanksgiving. I guess I've never bought a turkey on...
There's our takeaway, folks.
I learned something today.
Don't quote me. If there's one, when I first started grad school, this professor who had been there a really long time says, like, you guys are going to go to grad school, you're going to learn a lot, but don't use your graduate degree to assert, knowledge about everything. One thing really narrow. And so, I know a lot about indexing maybe, but I definitely don't know a lot about turkey supply and demand and pricing factors. And so I'm sure someone will, correct me that like, at my market basket, turkey shot up 20%, on Thanksgiving. So don't quote me on that.
That's funny.